Good day, everyone. Welcome to our confidential report for the 4th of November 2020. The markets are on a bit of a knife edge, or they have at least been on a bit of a knife edge for the last couple of days. Probably a bit of that is due to the American election, but there are other causes which are critical. Obviously, they're busy in America counting the votes right now, and at this stage, from where I'm sitting, it looks like Donald Trump is going to win again, whatever you may think of that. However, I don't think that the American election is going to be a big negative for the stock market. I think the stock market is going to continue to perform. On Friday last week, as you can see on the chart in front of you, the S&P 500 closed down about 7.5% at this point where my arrow is. And you can see that it came down during the day, intraday, and touched this support level, nearly touched the support level at 3246 and then bounced off it. I always thought it wouldn't penetrate that support level, but you never quite know with a correction like this. So from the cycle high, it was down 7.5%. Bit of a knife edge there. The question is this a double top here that we see here, the record high there, plus this cycle high here? Is that a double top, a descending double top, or is this a double bottom? That's really the question you have to answer as a private investor. Obviously, if it breaks down through the support, the next support level is at 3002 over here, which coincides with this low point here. We don't think that it will go down that far. We believe that the 3246 level will hold and the market is bouncing off it. Of course, October month is now behind us, and October is always associated with negative sentiment as far as investors are concerned, but it's behind us now, and we're moving into the festive season, the Christmas season, and that period is usually pretty good for stocks in the days leading up to the festive season. But the critical moment has probably come and gone for private investors. However, there are still a lot of blue chip shares out there that are trading at significant discounts. And obviously, you're going to feel a bit of risk, but you have to remember what Warren Buffett said, that you must buy when others are fearful. So, if you don't feel the risk, you're probably not going to make any money. That's what I always say. But what is causing this correction, or what has caused this correction? Two factors really have caused this correction. The first one is the second wave of COVID-19, which is taking place both in Europe and America. And that is obviously scaring investors somewhat. People are concerned about a second wave. And then the second thing is the impasse over the $2.4 trillion stimulatory package in America. You may be aware that the Senate has been looking at this, and they're trying to negotiate a deal, but no deal obviously is taking place before the election. So those are the two factors. When we talk about the second wave, in our opinion, the second wave will be not nearly as bad as the first wave. And there's a few reasons for that. First of all, we believe that the treatment of this disease has improved radically, so that the death rate and hospitalization rates have come down quite substantially. The second factor that will make this second wave of the pandemic, less impactful is the probability that in the first 6 months of next year, there will be a vaccine of some sort, which will be improving the herd immunity of certainly first world countries, probably in the first half of next year. At the moment, there's a very promising vaccine called AZD1222 being developed by Oxford, and it's in clinical testing, so we're hoping that will prove successful. And there are a couple of others also that are in the wings. And of course, you must also remember that America and Europe are both already adjusted for lockdowns, for difficult times as a result of the virus. So they should cope a bit better this time than they did the first time. It's not a surprise. And if we look at that stimulatory package, which is being negotiated in the US at the moment, It's a massive package, $2.4 trillion, absolutely enormous. And I believe that that package will sooner or later be passed, no matter who wins the election. And I think that it will add to existing stimulatory measures. And I think that that will continue to boost the American economy. So we are looking at a double bottom here, with a bottom there and a bottom here. And we're looking at a bounce off that level, which will break this record high in due course. And of course, behind all this, the US economy continues to recover very well. Jobless claims are falling steadily, GDP is rising, and investors are now looking forwards into 2021 to see what they think will happen. And they're looking at the sort of issues which I have been talking about. The prospect of a viable vaccine next year will certainly change everything. At the same time, the Chinese economy is growing rapidly. In the third quarter, GDP was up 4.9%, which is an improvement on the 3.2% in the second quarter. September retail sales were 3.3% higher than in 2019. And of course, you know, China exports products all over the world, so that shows that the demand from the rest of the world is picking up. China could well prove the engine that drags the world out of this recession. But we regard this as a buying opportunity, an opportunity to pick up high-quality blue-chip shares at bargain prices. All right, let's move on to the budget. Obviously, that is one of the major events that occurred in the last month. And that budget comes down to one thing: cutting the civil service wage bill to get the debt level under control. And this, of course, involves the government reneging on its agreement with the unions for this year's increase, and that's worth 38.7 billion rand or somewhere around there. And, of course, it also means persuading the unions to take the next 3 years without any increases at all. And this seems like a tall order, but from the government's perspective and from everybody else's perspective, the logic is simple. For 15 years, civil servants have had increases above the inflation rate. In fact, the entire civil service is one grade higher in promotion terms than it was in 2006. They've basically been promoted too rapidly, and that, of course, means that they're on higher salary levels. SARS is saying that the tax collections this year will be down by over 300 billion rand over the next 3 years. Something has to give. Taxes are already as high as they can be. But a wage freeze means a confrontation with the unions. And we need to look at that. How well set up are the unions for this? In our opinion, the unions are not nearly as strong as they used to be. The strike which they had, the one-day strike which they had on the 7th of October was pathetic. There was almost no media coverage and very poor attendance. Those people who had jobs at that time wanted to keep them. They didn't want to be involved in any strike action. And of course, we've recently seen the radical leader of the union movement, Joseph Matunjwa, humiliated and emasculated during that 5-month strike in the platinum sector, out of which his union got absolutely nothing. He was forced, after 5 months of no pay, to accept exactly the same terms that the other unions had accepted 5 months earlier. Neil Froneman humiliated him, and he's really been very quiet since then. So Ramaphosa knows that the radical unions can be beaten. I also think that Ramaphosa's dissenters within the ANC are much weaker than they were before. Many of them are in trouble with the law, like Ace Magashula. Ramaphosa has the country's support behind him to bring the government debt down, and that's a major factor. So in the end, it will come down to political will. The will to oppose the union movement and to reorganize South Africa's union action and the laws which surround the unions and collective bargaining. So the midterm budget policy statement is dependent on basically 3 things. The 2 cuts of 160 billion and 230 billion in the government wage bill over the next 3 years. The government's estimate that GDP growth will be minus 7.8% this year, plus 3.3% next year, and plus 1.7% in 2022. It also assumes that there are no further shocks to the South African economy. So it may seem improbable to you that all three of these will be achieved. And if one of them comes unstuck, if one of them is not as we've explained here, then it will certainly impact further on South Africa. This budget was undoubtedly the tightest budget which South Africa has ever gone through. And Professor Michael Sachs, who's very well known in this country and he's a leading commentator, does not believe that the government can cut that 310 million from the civil service wage bill. When we look at the economy, Tito Mboweni is not hopeful about getting a $2 billion loan from the World Bank, probably because of the nonsensical decision to give SAA a further 10.5 billion rand. This is to fund a new airline with half the same staff that took the old one into liquidation or insolvency, and that at a time when airlines around the world are going bust. Certainly this SAA debacle is a low point for the Ramaphosa administration. Tito Mboweni has been against it from the start. And so he's done the only thing he could do. He has made all the parliamentarians very aware of where the money came from to fund this SAA nonsense. It's drawn from all 41 departments, but especially education and the police. So basically what he's saying, or what the parliamentarians are saying, is that getting SAA going again or launching a new business in the airline industry at this time is more important than, for example, security, the police, or education. And this is the second time that Pravin Gordhan has overruled a senior official in the government. The first time was at Eskom, when you may remember Hadebe was the CEO, and he said that there would be no pay increases that year for Eskom, and he was overruled by Pravin Gordhan. This, of course, ultimately led to Hadebe's resignation. Let's hope that the same thing doesn't happen to Tito Mboweni. Looking further afield in the economy, there was a 4.2% contraction in sales in August month in retail sales. That's better than expected. And the second quarter salaries fell by 9% according to the Statistics SA. FNB estimates that 2 million people did not get their salaries in April. But by September, FNB says 97.5% of people got the same salaries they'd got before the lockdown began. So the economy is rapidly returning to normal. Standard Bank says that 70% of its employees are now working from home. Not all of those will return to an office, so there is a glut of office space developing. Cisco did an international survey of large companies, and 53% of them said that they plan to reduce their office space now that COVID is sort of under control to some extent. So that's quite a major change in the economy and in the world. There will be less need for office space. No doubt about it. More people will be working from home. Okay, the Land Bank, of course, was short of money. We knew that even before this midterm budget policy statement. But what's interesting is that the Land Bank has cut its loans to farmers by 60% just before the beginning of the growing season. This could lead to a bad maize crop this year, and then from that a food shortage. So that is obviously an area which needs attention. The governor of the Reserve Bank, Letsetja Kanyago, says that administered prices have been rising faster than inflation, and he points to electricity, which is up 6.2%, water, which is up 10.1%, and municipal rates, which are up 4.6%, when the official inflation rate is 3.1%. So if you took out those administered costs, it means that the actual rate of inflation, excluding those costs, would be even lower than it is. And this is probably because of the fall in oil prices. So he makes a good point there. Those administered prices need to stay in line with inflation. If we look at Cyril Ramaphosa's recovery plan, it seems to be like this, that he's going to put in about 100 billion rands worth of seed capital and use that money to leverage roughly R1 trillion investment from the private sector for infrastructure. This process, if successful, will create about 800,000 jobs by the end of February 2020 if it is used to mobilize what are called shovel-ready projects, projects that are ready to move right now. However, the problem with this plan, as with every other plan, will be implementation. The ANC has got a reputation for making grandiose plans that look wonderful on paper and never get put into action. Let us turn our attention now to Eskom. I believe that Eskom is making progress. The new CEO, Andre de Ruyter, is having an impact. Of course, they have this huge debt of 490 billion odd, which is costing roughly 30 billion rand a year in interest alone. But de Ruyter seems to have a plan to deal with that. He's been negotiating with various European governments and banks to obtain what he describes as concessionary finance, which is finance which is offered at very low interest rates or even donated. And the motivation that these overseas banks and governments have to do this is that they want South Africa to move rapidly towards renewables, away from coal-fired power stations and towards renewables. And they're prepared to throw quite a lot of money at getting that done. So de Ruyter is taking advantage of that. And obviously it would mean that we would have to replace our coal-fired power stations with wind and solar power, and etc. But if we're getting the money to do that, and at the same time reducing our 490 billion rand debt, then it will be a major step in the right direction. De Ruyter is working with what he describes as a political task team, which is led by our Deputy President, David Mabuza. And that task team has cleared the way for Eskom to start recovering its debts from municipalities. The municipalities owe Eskom about 191 billion rand. So collecting that debt in will be a very, very big factor in reducing the debt of Eskom. Of course, the municipalities, many of them cannot repay that debt because they themselves are in debt up to their eyeballs. Then, of course, the task team also arranged for this 11.6 gigawatts of additional power to be added to the grid, of which 6.8 will be renewable. But that's not going to happen in a hurry. It will take time. But what de Ruyter says is that by April 2021, the electricity system will be much more stable. So that's April next year. And by September next year, there will be considerably reduced load shedding. So that's good news. There's also been a major change in the regulations which allows municipalities to source their power outside Eskom. So they no longer have to buy their power from Eskom. They can buy it from an independent power producer. The Western Cape is obviously moving rapidly in that direction. But of course this takes customers away from Eskom, and it means that Eskom is going to have to become much more competitive if it wants to survive. All right, let's look at the Rand quickly. The Rand, of course, discounts much of what is going on around us, and both inside South Africa and outside. Just want to put a bit more data on the screen here. Right here you can see the Rand over the last 7 or 8 months, and you can see that it's been oscillating from risk off to risk on. So whenever the world economy, international investors move into a risk off mode, when they're taking money out of emerging markets like South Africa and putting it into safe assets, so-called safe assets like US T-bills, then we get to risk on, and that causes the Rand to weaken. On the other hand, when investors look at the returns that they can get from South Africa and they become less scared, then they obviously take their money out of low return assets like US T-bills, and they look for good real rates of interest such as that they can earn from South African government bonds and other investments. Then they bring their money back into South Africa and the Rand strengthens. So you can see we've been also alternating from risk on to risk off to risk on to risk off, risk on, and now we're in a risk off phase. And as you can see yesterday, the Rand strengthened significantly down to 16 Rand to the US dollar. We believe it's going to break below that level, and we believe in fact that the Rand is significantly underpriced on world markets. But while we're talking about the Rand, I just want to say that last Wednesday something happened which is quite instructive for private investors. It was a day on which the S&P 500 fell 3.5% because of the fear of a second wave of the COVID pandemic that day. And of course, markets in Europe anticipated the fall in Wall Street. And on that Wednesday, they started falling and the JSE fell with them. But that had nothing to do with the budget, the South African budget. In fact, it was completely irrelevant. It was just a total coincidence that happened on the same day that the budget was actually given by Tito Mboweni in Parliament. So South Africa followed Europe down, but that had nothing to do with our budget. In the Business Day, Carl Ganitsky said, South African assets, including the rand, bonds and stocks, came under pressure on Wednesday after Finance Minister Tito Mboweni unveiled a bigger than expected budget deficit. That connection is completely unwarranted. Of course the JSE fell, but it fell because the S&P was going to fall. It fell because markets in Europe were going to fall. There was a sharp move towards risk off on that particular day in the international markets, and that hammered our rand and our stocks and bonds. So he made a connection which did not actually exist. The MTBPS, the midterm budget policy statement, had almost no impact on the rand at all. So as a private investor, you just need to be aware that journalists often make connections which suit their storyline. And you must gather the facts for yourself and make your own mind up about what you think is going to happen. So our view is that the rand is basically undervalued and that it will continue to strengthen. Of course, there will continue to be episodes of risk on, especially as it now looks like Donald Trump may win this election. And so we've got 4 more years of Trump erratic behavior to contend with. And that will undoubtedly impact on the rand at various times. But the rand should continue to strengthen against the US dollar. That's our view. So that has obviously got an impact on rand hedge investments and various other things like South African inflation. One of the factors that is impacting on the rand is the rising number of arrests and imminent arrests. Magashula and Mayeni and others who seem to be in the wings and waiting for their time to come. Philip Truter, who was formerly the chief financial officer of VBS Bank, has turned state's evidence, and he's brought a lot of documents and evidence with him. That has got to be causing a lot of people sleepless nights. But all these arrests and the move that is taking place now have a huge positive impact on the rand. They strengthen Ramaphosa, and they strengthen international perceptions of the way South Africa is being run. All right, so now I want to just turn our attention to some general points. First of all, the new land expropriation bill, which is being put out there, should put investors' minds at rest that there's not going to be any kind of land grab. The land must be unused and held only for capital gain. And even then, it is the courts that will decide whether the land can be expropriated without any compensation or not. So that is a positive step in the right direction. Of course, I'm quite sure the EFF and Julius Malema will oppose it radically, but that is what has been decided. The South African Broadcasting Corporation, which received 3.2 billion rand bailout in 2019, expects to make another loss this year of 1.5 billion and is back at Parliament with the begging bowl. They are looking to change the law so that pay TV providers like MultiChoice will have to pay for their free-to-air channels, which they are forced to put out on the air. And that obviously would be a way of financing them, but it will put up the costs of a company like MultiChoice. Basically, the SABC needs to reduce its massive staff, which is over 3,000, and be a bit more businesslike. Okay, let's turn our attention to COVID. The University of Johannesburg says that South Africa is suffering from COVID-19 fatigue. Most people in South Africa don't think they will get COVID. They think the threat is exaggerated. Mask wearing has declined. Many are not covering their noses when they do wear a mask. Social distancing is also down. Sanitizing is now left to customers when they walk in the store without any supervision. And this is probably because South Africa has a much lower hospitalization rate and a much lower mortality rate than other countries in the world. The approval of Ramaphosa's handling of COVID has dropped from 85% to 65%. But at this point, it's good to compare our performance with that of Australia. Australia's population is about 25 million, which is less than half of South Africa's population, which is 59.3 million. But Australia has had less than 1,000 deaths, and that compares to the 19,500 that we've had here in South Africa. That's official deaths. For example, in Australia yesterday, there were 8 cases, 8 new COVID-19 cases. That compares to our situation in South Africa, where we had 1,240 new cases yesterday. And the Medical Research Council says that excess deaths for the last couple of weeks have been rising above the norm. So that's something to be a little bit concerned about. Much of that is taking place in the Western Cape, but hospitalizations seem to be pretty static. So maybe that is just an asymptomatic spread of the disease. Let's look now at commodities. Mining production in August was just 3.3% below 2019, much better than expected. July, remember, was 6.5% below 2019, and June was 25% below 2019. Much of this is because there's been an increase in demand from China for raw materials, for our raw materials. There's a mine in the Northern Cape which is being brought into production over the next 8 months. It's costing 250 million rand. It's going to produce manganese, about 30,000 tons of manganese ore per annum. It will obviously create jobs and so forth. But that mine is going to be completely powered by solar power. Eskom is found to be too expensive and too unreliable. In fact, the world demand for coal is falling sharply due to COVID-19. There's been a rise in renewable energy and the uptake of electric motor vehicles. BP has suggested that 2019 will prove to be the highest oil consumption year worldwide. In other words, oil demand will drop from 2019 onwards. That is quite a significant turning point, in my opinion. Of course, the outcome of the US elections will be critical for global warming. Now that it looks like Donald Trump will win again, it may well take us past the tipping point. Finally, while we're talking about commodities, we can't ignore the Leopard gas find by Total, which adds to Brulpadda. This is a massive gas find, and it's very, very significant for South Africa. Over the next 20 years, that will probably bring in about 1.5 trillion rand. That is what the estimate is. So it's a real game changer for South Africa. But nothing is going to happen quickly, but it will probably start to have an effect in the next 3 or 4 years. Okay, let's look at some companies now. The first company I want to look at is a real estate investment trust called Texton. This is a small real estate company that's been having a lot of difficulties and trouble. But what I want to draw your attention to is the rampant insider trading that occurred in this particular share. If you look at the chart here that I've got on the screen, the top chart is a standard candlestick chart like any other candlestick chart. The middle chart is an on-balance volume. I have spoken about on-balance volume before and how it's calculated. And then the bottom chart shows you the volume traded each day, and the black line that runs through the middle of that is a 30-day average of that volume. So what you can see here is that this company, Texton, has been the subject of a takeover bid, a mandatory offer. A consortium of investors who were the biggest shareholder in Texton, they had 32%, decided to increase their stake to 40%. So in terms of the rules of the JSE, as soon as you move above 35%, you're required, you have to produce a mandatory offer. You have to offer all shareholders to buy out their shares at that same price. So that price in this case was R1.20. So you can see that for many months before this happened, the share was trading around 70 to 80 cents. This is the zone here. And the volumes were very, very low. In fact, I can tell you that the average volume over that period was about 170,000 shares per day, right up until this Wednesday here, which was the 28th of October. The next day, there were 28.2 million shares that changed hands. And you can see the share price went up slightly on that day. And that triggered the on-balance volume chart. You can see on this day here, which was the Wednesday, the 28th, the price closed at 74 cents. Here it closed at 78. On this day, as you can see from the screen now, there were 4 deals done. 28.2 million shares changed hands, and they changed hands 4 cents more expensive at 78 cents. Now, the next day after that, which was the Friday, a public announcement was made about this mandatory offer and the decision by this consortium to buy out 40% of the company. That was the next day. But the trading, the insider trading, took place the day before, on the Thursday, 28.2 million shares. You can see how much more volume that is than the average of 170,000 shares that had been trading on average up until that time for months before then. So that's a blatant case of insider trading. But what you've got to learn from this as a private investor is that insider trading is always visible in the volume traded. And you can see this massive spike in volume here that showed you that. So I'm just drawing your attention to that. Those insiders, by the way, that bought those 28.2 million shares made a net profit, paper profit, of course, of about 10 million rand off that deal, just over 10 million rand. So it was very profitable for them, whoever they were. But in any situation like this, there are always 5 or 6 people who have the information before the market does, before the public announcement is made. And those people will inevitably trade on the inside information. It's illegal, and it goes on all the time on the JSE. So just be aware. Keep your eye on the volume traded, especially in relatively thinly traded shares like this one. Okay, now I'd like to turn our attention to Fairvest. Fairvest is also a real estate investment trust, and it concentrates on small rural shopping centers in South Africa. And it's been very, very successful in doing that. Just want to put a bit more data on the screen here. You can see how COVID-19 impacted the share, but it's now in a new strong upward trend. And what I just want to draw your attention to is that the price, which closed last night at 165, is considerably below the company's net asset value of 221 cents. We think this share is well run. We think it's on an upward trend, and we think it's cheap at current prices. Okay, let's look at MultiChoice. Obviously, you know MultiChoice is a pay TV company that was spun out of Naspers earlier this year, in February last year, 2019. It has 19.5 million subscribers in 50 countries around Africa mostly. The subscriber growth has been 14% in the 2 years, each of the 2 years since it listed. At the moment, there is a takeover bid taking place here. A French company called Group Canal Plus has just increased its stake from 8% to 12% in MultiChoice. And that means that it's probably going to do a takeover. MultiChoice would be a very good fit for Canal Plus. Give it a huge penetration into the African market. And you can see here the rising volumes. I've drawn a trend line in there to show that. And of course the rising the rising price. And we believe that a takeover is probably imminent. Okay, the next share I want to just talk about is one of our old favorites, Capitec. Obviously, this is a banking share which was unbundled from PSG. Just put a bit more data on the screen here, maybe a bit less than that. There we go. And you can see here that the share after the COVID-19 fall in March, the share has been tracking through what we call a triangle. You can see it's a descending upper trend line and a rising lower trend line. And that finally came to a head over here where we had a clear upside breakout. And in fact, we made a comment in September that you should buy this share if you could get it below 1,000 Rand. And it's now trading for 1,224 Rand. So it's gone up very substantially, and it's broken above this trend line. So that was a potential opportunity, is still, in our opinion, an opportunity. Capitec Bank is extremely well-run company. Okay, the next one I want to look at is Omnia. Omnia is a fertilizer and explosives company. This company, we've been talking about it for some time. Maybe just go back to it too. Even pull in a bit more there. You can see here, well, there's a 200-day moving average. We've got an upside breakout which occurred over here on the 22nd of June. We originally said you should wait until it broke up through the 200-day moving average. There you can see the break. And on the 28th of July, we adjusted the opinion for this share and said that now that it had broken up, it was probably a good buy. Since then, the share has gone up very strongly. It's up about 38% in 3 months. So that's very good. It's broken up through the 200-day moving average, and it looks like we've got a new upward trend there. The next share we should look at is EOH. This was the world's largest, Africa's largest IT company and a major institutional favorite. I'm just going to put quite a lot of data on the screen here, 10 years of data. As you can see, it was going up and up and up. There's the 200-day moving average. Then in 2015 and again in 2016, it made a descending double top. And after that, the share fell. And we suggested to you then that you should stay out of the share until it broke up through the 200-day moving average. It appointed a new CEO to replace Asher Bobot, who was one of the founders. That's never a good sign, by the way. And then that CEO was replaced by a guy called Van Coller. And Van Coller has been steadily fixing the company. Then, of course, along came COVID, and the share fell heavily on COVID, reached a low point over here at 230 cents. And since then, it's been tracking up because Van Coller has been making some very good changes. He's reduced the number of subsidiaries from 200 down to 3 divisions. He sold assets and cut debt. We advised waiting for a break up through the 200-day moving average, and now that breakup has happened, as you can see here on the right-hand side of the screen. So maybe it's time to look at this share again. Finally, last share, IAPF, Investex Australia Property Fund. This is a very interesting share. Just put a bit more data in there. There you can see it. It's a real estate investment trust which has got properties in Australia and New Zealand, nothing in South Africa. Owns about 30 properties over there worth about 1.1 billion Australian dollars, mostly in New South Wales. It's trading on a yield of 8.8%. It's a very good yield, and it's an extremely well-managed rand hedge share. In the results for the 6 months to the 30th of September this year, headline earnings per share climbed by 16%. It has an occupancy of 97.5%, and rental collections are at 99%. Obviously, this is a company which is benefiting from the extremely well-managed COVID situation in Australia. So we recommend that you take a look at that one. Well, ladies and gentlemen, that's about all I have for you this month. I hope you enjoyed it. I hope you got something out of it. And I'll talk to you again on the first Wednesday in December.